From the morning reading, the S&P rallies in the short-term sideways channel. Facebook soars. CAT gaps higher. 8 of 9 sectors moved higher on Thursday. XLE, XLU, and XLK were the strongest sectors, while XLV was the weakest sector. Oil rose $1.56 to close at 33.72. Breadth strengthened as advancers led decliners 2.03 to 1 on the New York Stock Exchange and 1.07 to 1 on the NASDAQ. The Federal Reserve is confused. Either that or they don't want to tip their hand to the markets, which is unlikely. Fed policy outlook has had an impact on investor sentiment, and yesterday's statement didn't give investors much to go on. For only the fifth time in 136 meetings since the Fed started clearly articulating the biggest concern to their policy decisions, they neglected to do so yesterday. Energy stocks are nearing an important juncture. The optimism index on the XLE exchange traded fund jumped to 88 on Thursday and has averaged 76 over the past 3 days. Each time sentiment got this high last year, XLE settled back in the short term, then climbed again, marking its peak before another sustained leg lower. Sentiment surveys are starting to show a mild rebound from pessimistic conditions. Even so, the latest update to the AIM model was unchanged at 8%, the second week below 10%. If we operate from a worst-case scenario like early 2008, the rebounds didn't peter out until the model rebound back to neutral territory, which would likely be at least 2 or 3 weeks away. Hello, this is Stephen Harris, a head trader from the Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:23 a.m. Central Time, and I'm recording this in preparation for the market day of January the 29th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into the morning report. And looks like we have some pretty positive action. And indeed, it's pretty much positive everywhere. The one odd thing is that bonds are up very large at the same time the market is up pretty significantly. In terms of the S&P futures, are up about 15 points at the time of this cut, or close to 1%. The Russell futures are up over 0.5%. NASDAQ futures are up nearly 0.2%, and Dow futures up about 0.75%, similar to the S&P futures. Crude oil hasn't really moved that much, up about 0.33% compared to recent overnight volatility. You have euro down about 0.25%, and then as I mentioned, bonds, the long bond up almost 1%. Gold down about 0.25%. In overseas action, you have China up over 3%, Hong Kong up 2.5%, Japan up almost 3%, Germany up about 0.5%, United Kingdom up about 1%. So very, very positive action across the board. For today in the U.S. macroeconomic reports, we have advanced GDP, and that is a very, very important report. And we have, let's see here, employment costs, good trades balance, Chicago PMI, and the University of Consumer Sentiment. So quite a load of reports coming out both pre-market and during market hours today. So be aware of that with your day trading. In terms of current volatility conditions, short-term VIX still up underneath a 25 level, but still has not fallen below 20. Skew also still in that range just above 125, at which level we start to take note of it. The IV percentiles, these continue to drop a little bit. We're down to 36 on the S&P, 45 on the Russell, 44 on the NASDAQ, and 42 on the Dow. There were no standard deviation moves put in by any of the indices yesterday, though the Qs were really, really close, and if I had rounded up, I could have called that a 1 standard deviation move on the NASDAQ. So relatively quiet the last couple days, little bit of action in the NASDAQ and Dow. Though if you look at the chart, we've had this continuing range. Let's zoom in here, and I'm going to use the ES first, and you see we're kind of just bouncing back and forth between the upper and lower part of this range. This is probably more easily seen on the day chart, and you look at this. I mean, this is really tight, and yet at the same time, these are not small bodies up till yesterday. And we had basically four bodies here that basically each day reversed each other. We had a probe above the confluence zone on Thursday, as well as a slight probe below. And again, another slight probe below yesterday, but initially the bulls took that back and we ended up positive for the day. But until we break in the short-term pattern, we break either below this area, about 1872 in the SPX, or we break above and close above, and we'll call this about 1910 or so. Until we get a close outside of this area, this is a trading range, and it's very difficult to make a prediction as which way it would go. Normally, I would expect it to break down, that this is just something of a continuation pattern where we come down, we have a bounce, a reversal, which did confirm, did break out of the diagonal resistance, but then the bulls were not able to master any additional momentum, and then now they're kind of slugging it out between the bulls and the bears in this last week's pattern. And you see we're starting to get these probes on the outside, but yet those probes get rejected. So it's a pretty interesting pattern, and until we see a breakout of that, we really won't know much. If you look on the weekly, also an interesting pattern here. Not the kind of confirmation on the weekly that you're looking for with the big tail down here. You want to see a confirmation with the next candle. That could still happen. The day is not yet closed yet. But at the same time, you know, certainly not the kind of vigorous confirmation that we've had in the past. If you look at these big tails down here, you know, so we come back, big tail, look at the next candle. Come down, big tail, look at the next candle. Bit of a reversal pattern, next candle. Big tail, reversal candle. So, you know, in each of the prior cases where we had, you know, kind of a pullback within a bull trend, we pretty much very quickly in the following week had a very nice next follow-through candle, and that so far isn't placed here. So we're going to watch to see how that closes today, and that could be indicative that this is just going to end up being a complex bear flag pattern and then back down. Now remember, we're talking about three different options here. There is the potential that this is a capitulation bottom and that we then move back up towards through increasing numbers of lines of resistance, but back up towards the upper part of this big wide range. The second part is that we could roll down and then just go into a sideways chop pattern in a lower range, and that frankly has been increasingly becoming the more likely scenario. And then of course the third is that if we break this low at 1812, then that would be very, very ominous, and especially a close below this 1812 area that would likely push us into a full-out bear market, and we would start, instead of talking about being down 15%, we would start talking about the potential for 20 or even 25%. So that's the three scenarios. Right now we're waiting to see if the market will tip its hand. Obviously at some point it will, but we're wanting to get some indication as to which of those three scenarios is the more likely scenario to play out. In terms of the Dow, very similar action there. NASDAQ, of course, has had itself rocked by some significant earnings reports. We've had huge misses by Apple and now Amazon, and certainly that is going to play into it. In fact, if we look at the NASDAQ futures, it's all over the place. Microsoft had a good report, but the others have had poor reports. In fact, we can look at Amazon, and you can see in the aftermarket, it is just cratered. This is a stock that not too long ago, so let's say we're trading around, we'll call it 574. Not too long ago was about 700, and to be down here around 574, that's a big drop in a relatively short period of time. Obviously better than the swing low there, but certainly some damage done there. Okay, let's take a look at volatility. Volatility's been in something of a confluence pattern as well. And then bonds. Bonds, big move in the overnight. And coming up here against its former, look at that, isn't that amazing? You know, you hear people say, oh, the market's random. That's like poppycock. Yeah, it just turns on the dime at that price for just random. There's no coincidence in that at all. But obviously, as the cash market comes in and we start to see the full participation of all the market players, be interesting to see if this indeed gets through this area and we start to see a significant move by bonds. You know, look at this. Look at that. Triple top. We've been watching that. We have a partial covered call on our TLT position and part of our core portfolio, and thinking that this would likely be an area of resistance. At the same time, we only did it partial because if indeed the market does break down, we likely could see it break through what is now a triple top and, you know, move towards this next area at least to here, about 163 and 30 seconds. If it gets through there, then we probably go all the way up to here. If those things happen, and we talked about the potential to watch the bonds, if the bonds break, we probably see the market breaking down. Now, so far, last night, the bonds are breaking way up and the market's also breaking up. So kind of an unusual lack of inverse correlation that we would normally expect in those two market relationships. Let's go to the daily report. Not a lot of change from yesterday. There is some though. We're still phase one. We've been talking about where we're very close to the criteria to achieve phase two, but that did not happen so far. So we're still in this bear flag reversal, kind of the fat toe in the water, but with the potential to sell out of the money puts and reduce stock positions. Very defensive phase. The portfolio investor posture still has that IBD status as confirmed uptrend. The accumulation distribution score in the S&P a lousy E. The NASDAQ also still an E. GMI index remains a 0 out of 6. One change we did have from yesterday is on the decision point scoreboards. The NASDAQ lost that long-term up green arrow, so now there is not a green arrow to be found on any of these markets on any time frame. We do have some neutrals still, but if you're a bull, there is not much hope in looking across this assortment of mechanical signals. And indeed, with the one exception of the confirmed uptrend on IBD, and I remind you, we've had now some 13 signals since the beginning of 2015. The prior 12 signals have all failed. Now, we're a very big fan of IBD, and we think that system is a great system. And yet, at the same time, you have to recognize that when you're in a sideways, range-bound market, you often get whiplash on both sides. And this seems to be what's occurring here. So this one lone bullish signal in this package of different systems that are all looking at this portfolio investor posture kind of setup isn't very convincing. So we're saying that the market is still in transition, and yet at the same time we're saying that this has got a very kind of bearish stance. An intermediate term market posture We still have that bullish intermediate term market posture that has now persisted for several days, but we have that mixed with the bearish sentiment line, very bearish sentiment line, and that very bearish sentiment line would tell us that moves would be expected to be more pronounced to the downside and shorter to the upside until proven otherwise. In terms of position sizing opinion, no change from yesterday on the one system up to 100%, and the other system between 50 and 75%. We mentioned the intermediate term market posture, and indeed everything is in the bullish camp. They're all over 20, but just barely over 20. They've ebbed up ever so slightly in the last two trading sessions. So, this continues to hold, but it's clearly a very, very weak bullish market posture at this point, and could easily turn back down with a big down day. In terms of the hedge warning status, we retain the level 1 plus, which is our yellow light. This is to say that while we're not predicting a down move and we're not predicting a degree of down move, we are saying that the conditions are present that a significant down move is elevated. And certainly this is not a 3. We spent quite a long time at risk level 3 up until just a couple days ago. So conditions have improved and not quite as risky as they were. We still have elevated risk conditions. Indeed, if you look at a couple other signals, the stocks on a short-term risk are a 7, so relatively elevated, and medium term is relatively benign. In terms of those specific warnings, we still have quite a few warnings here. Market in decline, sharp increase warning, and the VIX up over 18, all coming from the volatility-based systems. Look at the skew also still remaining up above 125, so the beginning of the warning level there. Current week out expected move continues to be elevated, though this number has been sliding down slowly but surely. New highs, new lows, nothing really to get excited about there yesterday. Neither one of the high or the low is at a warning level. We continue to see this kind of relatively weak action, though, with not a lot of companies putting in new highs on the 1 month basis. Intermarket risk aversion indicator still 3 risk off against 2 risk on, so not as bad as it was a few days ago, but still continues to be, certainly a warning status. Fear and greed index, still an extreme fear, but improving. We've seen this go from 13 to 19 to now 20 in the various time frames. In terms of special opinions, no change from yesterday. VIX is still outside the acceptable window to initiate new positions for novice traders, though more aggressive traders will find that the increased premium is certainly welcome. Just have to be ready to take on more delta moves and more vega moves, as the market certainly, when you have this kind of volatility conditions, will absolutely do that much more frequently. In terms of cover call strategies and put selling, same as yesterday, borderline acceptable. If you are wanting to do this, that fat toe in the water, as you would say, with market phase 1, use some of the defensive postures that are outlined in both of these areas. Sector market posture, you see some improvement coming in. Consumer staples and utilities holding up the best across the 3 time frames. And of course, they're defensive sectors. So the fact that these are the ones that are showing up as the strongest is a bit of a warning about the overall status of the market. Though we will note some kind of odd exceptions. Energy, which has just absolutely been pummeled of late and has been kind of universally down, 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 has started to show some action of, really finding something of a bottom potentially, and has started to show up in some of these time frames on the sector market posture. And percent change, you see energy here yesterday up over 3%, and for the week up nearly 6%. So that is quite a reversal, especially if you put it in the context of where the 1 month, the 3 month is, even from January 1st. Quite a reversal, though it's got a long way to go. This is an area that got really, really hurt in the last year. Healthcare down big, and I believe this was mostly from the biologics. So biotech, IBB, kind of on an ETF basis, was certainly, uh, my understanding, was the big player dragging healthcare down. When you look at the healthcare sector, you have to remember you have kind of a bipolar area there, in that you have some that are very, very defensive, hospitals and so forth. It doesn't matter if you're in a recession or not, hospitals will still crank out an awful lot of their revenue and not have an awful lot of a dip, and certainly not the same sensitivity that other areas might have. Insurance companies and the like, obviously everybody's affected to a degree by a pullback in the economy, but there are some places where, if you have a heart attack, you're going to the emergency room, you're going to get the ambulance, and you're going to get the critical care. It doesn't matter whether it's the middle of recession or not. Whereas other areas like biotech can become very, very high beta, very, very volatile in market downturns, and that's a big component of the healthcare sector. So sometimes you'll get these big extreme moves in healthcare, and you have to kind of ask a couple more questions. Where is it coming from? And let's see, I think that's probably enough on that today. Let's go ahead and move forward. Here's a couple places, directions here on how to get into the email distribution. I won't spend any more time on that today. I will say that if you like what you're getting from here, you find it helpful to your trading, we ask two things of you. That one, that you subscribe to the YouTube channel, and that'll give you an alert that content has been posted. Give it a couple minutes to be available to you in high definition. If you hit the little gear setting button, that'll allow you to choose high def, and that certainly gives you a better view of the charts and other graphics and so forth. The other thing is you have the ability in that same setting place, that same setting button, to speed up the video and kind of move this along a little quicker in your pre-morning routine. So I'm going to just scroll through the rest of these. We've gone a bit long today. If you find something of interest, just go to the hyperlink and you can get greater details. Disclaimers, as always, hit the pause button if you need more time to review, and you see the hyperlink near the bottom with the full disclaimers. We'll see you back here on Monday morning for the Falcon Global Market Preview. Good trading.